Nigeria's pension industry has quietly become one of the most powerful pools of long-term domestic capital in the country. In 2025 alone, we saw a 22% year-on-year asset expansion to 27.45 trillion naira, reinforcing the contributory pension scheme as one of Nigeria's most resilient financial institutions despite a volatile macro environment. Now, at the same time, pension funds are gradually increasing exposure to infrastructure, private markets, and alternative assets. Yet, infrastructure still accounts for less than 2% of total assets, even though the regulatory limit is far higher. So the question is no longer whether the industry is growing, but how strategic that growth is and how transformational it can be for Nigeria and Africa. Joining me here in our Lagos studio is Oguche Agudo, who remains with us from the previous segment and is founder of HRISP Partners and former CEO of the Pension Funds Operators Association of Nigeria, where he helped guide Nigeria's $30 billion pension industry towards deeper national impact. And joining us also live from Abuja studio is Mahmud Sulaiman, who is Managing Director of CardinalStone Pensions, a seasoned operator with more than 2 decades of experience in banking and pension management. Gentlemen, welcome to Business Week. Thank you for joining us this morning.
Thanks for having me.
You're most welcome. Mahmoud, I hope you can hear us as well. Yes, you're most welcome. All right, let's open up with the wider industry landscape, and I will pose this question to you both. So let's begin with Mahmoud, seeing that you're over there. We know that across Africa, pension assets are growing steadily, but allocation to productive sectors like infrastructure, private equity, and long-term enterprise remains relatively modest. Are African pension systems still in capital preservation mode, or are we at an inflection point where pension funds can genuinely become engines of economic transformation?
Okay, thank you. It's a pleasure to be here. So I think we're at an inflection point, I would say. The industry is growing, and we've gotten to a point where we have to move away from just capital preservation to assets that would really give real returns. And if you look at it, it's undeniable that the industry is at that momentum, and that growth is there. So before now, if you look at the asset allocation, you would see that, most of the asset, maybe 80% would be in government securities and maybe major corporates. But now you're seeing there's a shift, less fixed income in that space. Now you're seeing the alternative assets that you have spoken about. In terms of regulation, I think the news is loosening a bit for the operators, and the allowable asset classes are moving away from the traditional fixed income and equities. Then if you also look at, the market in itself, the market is going to be more sophisticated, meaning that, the industry is just 21 years. It's, I would say it's nascent. But again, with the coming of the infrastructure assets, we have to ensure that the market is ready to accept those kind of assets. Then I think a major reason why the alternative assets have not been very popular is, the risk element in it. Before now, PFAs would typically run away from the risk. But now, we're looking at, de-risking tools. How can we de-risk this product? How can we make them, bankable, viable asset for us to invest in? But yes, I believe that, the industry is changing, and right now we are at that inflection point. And going forward, we would see increased asset allocations in these asset classes.
Right, so we are at the inflection point, and market readiness, as you mentioned, cannot be underestimated. Ojuche, do you echo Mahmoud's thoughts on this very quickly?
Yes, I think the sentiments are shifting, led by the regulator. The regulator has given direction and directive. But also, these asset classes, they portend potentially higher revenue for the RSA holders. So for pension funds, if they want to keep their RSA holders, if they want to deliver higher returns, then they need to move into these other areas that deliver potentially higher returns. The challenge will now be, ensuring that, they're investing in the right kind of funds, they're investing in the right fund managers, and they're doing their due diligence, but those portend higher returns for the RSA holders.
Right, but due diligence part is also extremely important before that. But let's stay with you, Oguche, on this. We've seen Nigeria pension assets grow 22%. That's to 27.45 trillion naira as we speak. Now, beyond this headline number, what does this growth really signal about the maturity and resilience of the contributory pension scheme rather?
Yeah, I think it speaks to the consistency. It speaks to the buy-in of the greater economy, because what happens is that this is largely formal sector pensions. So when you get your job, you open your pensions account and your employer needs to continue to make those deductions. So every month this is coming. And that just speaks to the wider acceptance in the market. It speaks to consistency. It also speaks to the fact that the economy is adding new jobs. Salaries were increased last year. So this increase just shows the increased salaries. When salaries increase, of course, pensions increase. When people add new jobs, they add more pension contributors. So this growth just speaks to all of that in the economy. Increased salaries, new jobs, and the wider acceptance by the general public and compliance by the National Regulatory Commission. PEPENCOM have done a good job in terms of ensuring people are complying, ensuring sanctions to erring companies, and just ensuring that ecosystem is working well, whereby the general contributions and is consistent. It also speaks to growth in the investment of the pension funds, because there are two main ways which the pension funds grow, which is the contributions and the investment growth. So last year, stock market did well. The returns were fairly good, and so that adds to the growth in the pension.
And certainly also to this wider acceptance you speak of as well, because that also is, I would probably say, a gradual process. It takes some time, some sensitization, and, embracing to get to that point. Mahmud, let's come to you now from an operator standpoint. What drove the 4.94 trillion naira annual gain? Was it stronger compliance, equity market performance, or just better portfolio structuring?
Okay, I think it's a mix of all the things that you have mentioned. I think Oguche has spoken about, the regulator, the compliance bit. I think PFAs now understand the direction the regulator is going, and we're very big in terms of compliance. And most of it, most of that, the gains you talk about, came about from, the equities and fixed income. I think fixed income last year accounted for about more than 60% of that growth you're talking about, And when we look at the fixed income market for last year, I think the yields were at about 18.3, I think 100 basis points less than last year. But at least it's a significant improvement for the business and the growth in itself. And the equity market as well, it made its own significant contribution to the growth that you're alluding to. Last year, I think the all-share index gained about 51% or slightly more than that, and it's significant growth from last year. And I see that this year, that growth will continue to improve. It means that, the return on investment for the contributors and other fund sponsors would considerably be higher than it was last year. So I think the fixed income and, the equity market with compliance drove the yield you're talking about.
So a myriad of factors there, but ultimately a positive outlook, it sounds like. Let's come to you, Oguche. Infrastructure is a very important touch point when we have these discussions here, but we also saw the allocations there rise 48% year on year, that is. Yet they still account for just about 1.4% of the total assets. Why is there this huge gap between regulatory allowance and actual allocation?
Yeah, so I think infrastructure as an asset class, honestly, it's a new asset class. It wasn't there about 10 years ago or less. So the pension funds and Africa as a whole, we're just getting to the point where we see infrastructure as an assets class, right? That's one level. The second level is, where are the deals, right? So you don't expect the pension funds to just invest in any infrastructure. They need to be sure They need to do their due diligence. They need to ensure they're backing the right deals, the right fund managers. And also what you see is that it's a bit more difficult to invest in infrastructure, especially from a private point of view, than it is to invest in an equity or fixed income. Because if you want to invest in equities, you call your broker, you pick a stock and you invest same day. But with the infrastructure, whether it's the funds or the bonds, there has to be a process. There are legal documents, due diligence. So it takes a bit longer. So I think the 40% plus increase year on year is good. We'll see more of that. I know that there are already commitments by the pension funds to some more infrastructure funds. And as data comes, we'll see that growing. But I think it's gradual. It's a new asset class. Infrastructure as an asset class is new. And we'll see it growing gradually. It won't just happen at a go.
Overnight.
Yeah.
So in light of these facts you just placed, do you see this gap widening even further or closing at a certain rate?
Yeah, it's going to close. So pension funds are going to invest more in infrastructure funds and infrastructure bonds as the market understands this as an asset class. As we see various structures, as more fund managers coming, as more partnerships are coming, we're seeing international organizations coming to work with the local market, local pension funds. So we'll see more of that as the pension funds understand the asset class a bit more, as there's more de-risking. There's a lot of stuff happening in that space, and we'll see more. But I think it's gradual. It won't just happen like that because it's private markets. It takes more time, a bit more structuring, and it's not as easy as the public markets where you just call your broker and you just invest.
Right. Certainly, the risk mitigation is also very playing a pivotal role there. Let's come back to you, Mahmud. We see PFAs allowed up to 10% in infrastructure funds and 35% in infrastructure bonds. What practical constraints are keeping operators cautious here?
Okay, yeah, I think, first of all, I think I would commend the regulator for, giving those limits, improving those limits just to drive that asset class. However, it's PFAs have to be very cautious. Like Oguchi has said, most of this, it's a demand and supply issue, really. The PFAs are ready to receive these products. But again, are they available in the market? Are they available in the way that we would want to receive? Are they bankable? And for PFAs, we have you spoke about capital preservation, and that is one of the key principles of, what we do. We have to preserve capital. So any products we're going to invest in, we have to look at it. The regulation is there already. Yeah. So do they meet the regulatory guidelines for those products? In terms of, documentation, in terms of bankability, viability, sustainability, liquidity as well. And yes, it's a new product, but I think we're getting better. If you look at for last year, I think in terms of the infra fund, I think it was close to about more than 280 billion. Just for last year, and coming from maybe 5 years ago, that was less than maybe just 70 billion. That is progress, and I think we're making progress. So on the operator side, the competence is building in terms of the investment analysts, the kind of research we do on these entities, and for the entities themselves, they know what is expected for them to do, for them to be bankable, for their products to be investable for PFAs. So I think, in the very near future, we would see, the growth of the entire fund and significant contribution made by the infrastructure fund and the bond.
So very legitimate considerations on both sides, and expectations also one mustn't forget that. Let's come back to Oguchi. Now, with over 60% of pension assets in government securities, are we over-concentrated in sovereign debt, especially in an inflationary environment?
I don't think so, because I know what some other markets are doing. Some other markets are 80% in Africa or 90% government bonds. So Nigeria at 60% is not that bad, even though the regulatory limit has now been reduced to 50% maximum. So we're going to see this come down gradually to 50% maximum. But what needs to happen is that what is the other 50% invested in? How is it spread across various portfolios, and what's the return? With PENCOM, the signaling is towards higher income investments for the RSA holders. The DG of Pencom is focused on, we need to get more money to the pensioners. We need to ensure that their returns are higher. So that's where the signaling is. I don't think 60% is too high because, like I said, other markets in Africa are higher. But I think what we need to be focused on is the other 40%, what's invested in, and how are those returns helping to smoothing the overall portfolio and increase the returns for the pensioners and the RSA holders.
So again, you're saying no cause for alarm here. It's a decent area to be
it is
within.
I think so.
Okay. All right. Let's look at the contributors' funds now, and I will pose this to Mahmud in terms of balancing the duty to protect contributors' funds, that is, with the national expectation that pensions could then, help solve Nigeria's $800 billion plus infrastructure deficit. What are your thoughts on this?
Yes. Honestly, as an operator, I would like to be part of, the history in solving the government's, infrastructure deficit. However, I think we have to come as part of the operators to come together to see how we can do that. The PFAs alone cannot do it. The policies have to be right. The guidelines have to be right. And like I said earlier, the products have to be right. The demand is there, but the issue is the supply. For these infrastructural products, most of it, like I said earlier, do not come in the form of investable products. It is the PFA's fiduciary responsibility to preserve that capital. By law and by principle, we have to do that. If it's bankable, it would ensure liquidity, sustainability, then by all means, we'll be very happy to solve some of the infrastructure problems in the country, which would have a direct impact on the overall economic growth in the country.
Yeah, and I'm sure we'll all agree that the liquidity and stability are really key areas that we're all looking to achieve. We don't have a lot of time left, so we're going to wrap up with you, Oguche. We're looking at Pencom. We made some allusions to it earlier. We know that ratings requirements have tightened. Would you say that this regulation is currently encouraging prudence or unintentionally limiting diversification?
Yeah, what I always say is that if we're all honest, we want our pension funds to be cautious. We want our PFA to be cautious. We don't want them to just go out and invest in anything and everything, just chasing returns. Yeah. So cautiousness is good. It's not bad. I think it's the balance, right? And the regulation on just investing in, highly rated corporate bonds, I think is good because there has to be a balance there. Because when you retire, you want to be sure that there's money there. You don't want them to just go all out and just take any form of risk. So I think that regulation is in order. It's really just the balance. Pension funds should also take risk, but measured risk so that, they preserve capital. I think preservation of capital is key, but also, when people retire, they want to have their capital plus X. So it's just how the pension funds manage it. And that's what they get paid for, that balance that they need to.
Right. And of course, the cautious optimism as well, because it's great to project positively, but, we have to take the nice steps. I have a few more minutes, and let's come back to Mahmud. Let's ask you to look into your crystal ball here and looking ahead 5 years from now, what would you say Nigeria's pension industry looks like?
Okay, so I think 5 years from now, we'll see the alternative assets would be front and center in the asset classes. And we would see more involvement in the global market. Currently we're looking at the Fund 7, the dollar fund, and the years coming up, I think we would, start playing in the global market. I think we've mastered the local market, and I think you can see, the impact the pension fund is having in the local market, right? And when you speak about 80% or 60% in just government bonds alone, it's significant. And then 5 years from now, we should be looking at these alternative assets, having more limits, increased limits in asset classes, then, dollar-denominated funds, like the Fund 7, and, general involvement in the global market. When we get there, we would really know that, the industry has come a long way, and we've peaked at the local level. Now we look at the global markets. So I think in 5 years, that is what we'll be seeing.
So ultimately, lots to look forward to. But of course, all that groundwork is happening now. We all have to agree. If you joined us midway, I have been chatting with Oguche Agudo, who is founder at HRISP Partners, and Mahmud Sulaiman, who is managing director, CardinalStone Pensions. Gentlemen, I want to thank you so much for joining us on Business Week this morning. We'll see you again very soon.